Alright, let's buckle up. This video is going to be slightly longer. In this video, I'm going to show you how to compute all the ratios which you have to compute in financial statement analysis and valuation part 2. So in part 2 of the project, I have asked you to compute few profitability ratios and few valuation ratios. So in this video, I'm going to show you how to compute all these ratios in Excel file. So I'm going to use Procter & Gamble's standardized financial statement, which I have worked in part 1 as well. So to begin with, open this Procter & Gamble's standardized financial statement and write down all the ratios that I have asked to compute in the part 2 of the project. And to save time, I have already listed all the ratios that I have asked in part 2 in the Excel file. And also I have given you or written here the formula how to compute so that you don't get confused. And I would also suggest you do the same when you are doing for your company. Otherwise, sometimes it might be confusing. So the first ratio I have asked you to compute is the first set of ratios I have is profitability ratios. So let's start with the first one, which is EBITDA margin. So how we compute this EBITDA margin? EBITDA over sales, right? So you always start with equal sign. Find out where EBITDA is. So if you go in your income statement, you must have EBITDA. So this is in my row 67, this guy over sales, right? So the sales is the sales revenue. So which is the row 58. So if you put this and enter, and that gives you the EBITDA margin, which is 22.60%. And if you grab this little square box and drag it to the right, it gives you for the rest of the year. Boom, that's done. EBITDA margin is done. And I'm not going to explain what this means because this video is going to be very long if I do that, and I have other videos to interpret these ratios. Please watch them. And now let's go and compute net profit margin, which is net income over sales, right? So that equals to, let's find out where is net income, right? This is going to be in your income statement. Here I have in row 81, that is this guy here, over sales, right? So the sales is going to be here on the same income statement, so that's sales. So that gives me my net profit margin, which is net income over sales. And again, I can grab this little square box and drag it to the right. Boom, done. That is net profit margin. And you can see what is happening over period, and you can explain whether the company is doing better or almost the same or getting worse. So the next ratio is return on total assets. Again, that is net income over total assets. So let's see here, net income, right? Again, net income, you can find your income statement, which is here row 81, over the total assets. And you should know where you should get the total assets, right? It comes from your balance sheet. So total assets. So here I have total asset in row 27, right? So if you put these arguments and enter, and that gives you the return on total asset. Again, you can grab this little square box and drag it to the right. Now boom, done. So that is the return on total assets. So let's compute return on invested capital. And this is slightly more technical, but I have other videos that helps you to learn how to compute invested capital and return on invested capital. therefore I refer you to watch this video. I'm going to calculate directly here. So this is computed as net income over invested capital. So it's going to be equals to net income, right? So the net income is in my row 81 over the invested capital. So what is invested capital? So invested capital is always equals to your net debt plus the book value of equity. And you should know that net debt is always equals to the total debt minus the liquid asset, right? So I'm going to do this here. So I'm going to compute the net debt first, right? So net debt is going to be your total debt, right? So the total debt is always equals to your current debt, which is in my row 32, plus the long-term debt and leases, which is in row 35, right? So that gives me the total debt minus the liquid asset, which means the cash equivalents and short-term investment. Here I have the liquid asset in row 14, so minus row 14, so that gives me the net debt plus the book value of equity. So if you go on to your balance sheet on the liability side, and you can find the total equity here in my row 49, I have the total equity. So that all gives me the invested capital. So if I hit enter, and now it gives me return on invested capital, which is 12.18%. So you can grab this little square box and drag it to the right. So now this is the return on invested capital, and you can always compare this return on invested capital with a weighted average cost of capital and then see whether the company is adding value or destroying value. Okay, the next one I have is earning per common share, which is simply net income over number of shares outstanding. So I'm going to do this equals to your net income, right? So the net income is again in my row 81 over number of shares outstanding in my row 92 right here, and that gives me the earning per share. So you can drag this again to the right, and that gives me the earning per share for all the year that I am looking at. So I computed now all the profitability ratios. Now next I want to go and compute my valuation ratios. So all these valuation ratios are based on price and some company fundamentals, right? So I need to get the price of the company that I am looking at. In this case is a Procter & Gamble. So I need to get the price of this Procter & Gamble from anywhere you want, but I'm going to use Yahoo Finance because it is freely available and you can access every company's or most companies' price information in the Yahoo Finance. So let's go to Yahoo Finance and pull the price of this Procter & Gamble for the same time period that I'm analyzing, right? So let's go and type the finance.yahoo.com, right? So on this little box here on the right side, you can type the ticker symbol PG, and it will suggest you the here, and then then click on the historical data, and if you click on the historical data, and it gives you the historical price. So let's figure out what time frame we are looking at, and if you go back to our financial statement, we are looking from 6/30/2011 to 6/30/2017. So you have to select that time frame right here. So this is 6/30/2011, so I'm gonna do that is 6/25 and 2011, and then 7, so I have more data than I need, so I can pull all the data 7/30/2017, right? So you have to make that selection done, and here historical price You can also download dividend and other information, but we are just looking at the historical price, so I'm going to leave that historical price. And then now frequency, it is daily, weekly, monthly, and I would suggest you to use monthly. Daily is going to be very long, so monthly. Once you make that all selection, apply. Yes, you have all the data here on this page, or it is also stored in the Excel file right here, but I'm going to use right here. So what I have to do right now is I have to extract the stock price on these dates, and if you don't have the exact date, find out the price closest to that date. So I'm going to write the market price of that company here. So market price in June 30, 2011. Let's see how much it was. So here August. So here June 30, right? So it has the data on July 1, but it doesn't have the data on June. So I'm going to use the closest date, July 1, and I'm always going to use adjusted close price, this guy. So I am going to copy this 49.19 and then put in the Excel file. Alright, so similarly, now I can go and find the price 1 year later on 6/30/2012. Alright, right here. So it is 2012 June 30, right? So I might not have this June 30, so I do have July 1st 2012. So I'm gonna get the price on July 1st 2012, which is 53.34. Alright, so I'm gonna take that to my Excel file and copy it. And similarly you can do for all the rest years. Now I have the historical price of the stock of this Procter & Gamble for all year that I am looking at. Now what I can do is I can compute all the valuation ratios. Now let's go and compute the first one, which is price to earning per share, right? Which is computed as market price of the common stock over earning per share. And keep this in mind, in row 144 I have already computed earning per share, and I can use that to compute the price to earning ratio, right? So this is going to be the price over the earning per share. So that gives me 11.53. That should not be a dollar sign. So let me remove this dollar sign right here. That's a number, right? And you can grab this little square box and drag it to the right, and you can get the price to earning ratio for all the years. So next ratio is market to book, which means market price of the stock divided by book value per share. So that equals to market price divided by book value per share. How do you compute book value per share? Remember, book value per share is equals to total book value of equity divided by number of shares. So I can do that, bracket, now total book value of equity you can find right in your balance sheet, so which is your total equity in row 49, right, divided by number of shares outstanding. You can find that in your income statement. Here in this case is row 92. So that gives me book value per share, and when I divide this market price by book value per share, I get market to book ratio. And again, I can drag it to the right and get that number. In order to change the format, I can do that and then make this look better, right? So that's my second valuation ratio. Third one is price to sell. Again, price to sell is the market price of the common stock divided by sales per share, and that is going to be market price divided by, and I'm going to put this in bracket, sales per share means the total revenue, right? Total revenue divided by number of shares outstanding. So that gives me sales per share, and when I divide price by sales per share, I get the price to sales ratio. So once I compute for 1 year, which is 2011, and I can drag it to the right, and it gives me for all the years. All right, that's my price to sales ratio. And finally, I have now price to cash flows, which means is the market price divided by operating cash flow per share equals to price over cash flow per share, right? So that bracket close, and now you need cash flow from operation, which is in this case is row 116 over the number of shares outstanding, which is in row 92. So that gives me cash flow per share, and when you divide price by cash flow per share, and you can compute the price to cash flow. And once I compute again for 1 year, you can drag it to the rest. So this is how you compute all these ratios that I have asked. And once you compute these ratios, what I want to suggest you is also try to find out industry average for these ratios, and if you can find market, in this case I'm using S&P 500, find the ratios for the industry and market and put next to each other, and you can use these industry averages and the market ratios and compare with the company, and then you can write how the company is doing. One way to do this is to download Jack's report that I have uploaded in the canvas, right? And which I have already done here. So what I'm going to do is I'm going to use the Procter and Gamble's Jack's report that I have here. And right here, if you go further down, you will see some industry comparison, and you will see X industry in S&P 500. So you can copy some of the ratios available in this report and put next to Excel file, and then when you are writing a report, you can always compare all these ratios you have computed and then interpret how the company is doing. But one thing I want to make this clear, that not all these ratios that we have you can find in the Jack's report. So only the one which you can find, you can put next to your ratios and compare how your company is doing. And I'm going to make another video just to focus on how you write report using these ratios, and don't forget to watch it. Thank you.